It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, it's the Real Estate Breakfast covering the Australian property market for you this morning, from Cairns to Canberra and from Randwick to Croydon. Yes, all of the constantly changing parts of the property market. We are talking about those stories every week. And if you are on the Sunshine Coast in Queensland this morning, a very good morning to you, especially if you are in Caloundra, because we have the Caloundra property market update on the way. It is a Thursday, June the 25th. July ain't too far away. And congrats too if it is your birthday and you're celebrating. Ricky Gervais is right there with you. He is turning 65. And I see that it was on this day that Prince's iconic album Purple Rain, have you got that in the vinyl collection? That was released on this day in 1984. And some big news happened on this day for Apple. I'd forgotten about this. Microsoft announced a $150 million investment in Apple in 1997, which really did help stabilize the company at the time when it was a struggling tech company. Let's right now go to Melbourne. We are catching up with Scott Aggett, the founder of Green Shoots Property, and a very good morning to you. Welcome on to the Real Estate Breakfast. One of the biggest mistakes investors make right now in the property market is waiting until everybody is talking about a suburb before buying into it. The challenge is, of course, identifying areas with strong fundamentals before they become obvious. How do you think, Scott, investors should spot the next growth market before the competition arrives?
Good morning, Craig. Thanks for having me on the show. Well, it's super important to get to these markets at an earlier stage, because the alternative is that you're competing against a lot of buyer depth, which is going to continue to push prices high. You've got less motivated vendors because they know they've got a lot of other buyers behind you that are pushing to buy those properties. So it creates a situation where you're effectively paying a record price if you're buying in a hotspot market. You've got to identify where these markets are showing the early signs of growth, so tomorrow or future hotspots. And we do that by looking at long-term and short-term supply and demand metrics. We look at affordability within that suburb, like how long does the typical person on the typical wage take to pay off the typical mortgage there. So we're looking for very affordable markets where they haven't yet hit the affordability ceiling and they've got room to grow. We're looking at choking out future building approvals, so there's nothing coming down the pipeline in terms of big oversupply of property that's going to cap your growth prospects. We look at its 3-year, 5-year, 10-year past growth cycles, how much that's differed from the previous 3, 5 and 10 years. We'll look at how it's compared with its spillover with the local council authority, the other suburbs that are surrounding it, to see if there's a bridesmaid effect that possibly comes into play. So when you align all those data metrics, we can get a very clear picture of a market that is going to be on the march.
Now, property decisions, they are often driven by emotion, headlines and opinions, but successful investors usually rely on evidence. In other words, looking beyond median prices and focusing on deeper market signals that can reveal opportunities others miss. Are investors spending, do you think, enough time analysing data before making their next property move?
No, we know they're not. We know that's really clear to us, even just talking to our own customer base. So we can see that at the coalface, that that's not the norm of how Australians are buying. We also have a lot of data around people buying close to their own home, underperformance of, say, units versus houses, people that are making a sale of a property within a certain amount of short years that are not selling at a profit. So you can see people that have bought into markets there that were underperforming and have got out because it's not making them any money and it's a real cost burden for them. So we know for sure that the general public aren't getting access to those tools. And the other difficult thing that you mentioned there, the headlines that's driving a lot of the emotion for investors, is that they treat a market as one and a whole. So, for example, I'm in Melbourne today. You'll see in the paper non-stop in the headlines that Melbourne is down X%, yet all of our markets that we're buying in are in double-digit growth in the last 12 months. So they're outperforming the market because you don't buy Melbourne, you buy a particular street within a particular suburb, and you've got to get really granular in terms of the data at that level, not talking about a market that deep and wide.
In buying property, it's not just about finding the right home or investment. It is also about, of course, understanding the negotiation process. This is big. Vendor motivation, buyer competition and market conditions that can all influence the final outcome. So with millions of dollars changing hands every day, how many buyers are leaving money on the table because they negotiate the wrong way? It's a big one.
Yeah, this one is really close to my heart, Craig. I've spent the last 30 years doing over 4,000 property deals, and I sat on the agent side for 23 of those years. Based on my own research, I think Australians are leaving about $50,000 on the table for every $1 million that they spend. And the reason is it's very simple and easy as an agent to manipulate your emotions to get you to pay that emotional premium, which is what we're employed to do. Whilst that system remains in play and the motivation is to work on the vendor side, who's your employer, they're going to extract and push and pull as much as they can to get you to pay an extra $10, $20, $30, $50,000 in that instance that I just used as an example. The reason why most people can't reverse that is because they don't understand the psychology of a seller, the agent, the motivations, how to ask the right questions at the right time, how to leave space after their questions of silence to understand how an agent responds and the nuances that are involved in that. And then the magic is in that listening and asking the right questions. And when you do that, Craig, you can really unlock some super value. So I think that, if you're inexperienced in that space, you need to work with an expert negotiator because they will add a tremendous amount of value. And it's that third party leverage that makes a significant difference. Very difficult to negotiate you versus an agent. When you can start to include talking from a third person, it's a lot easier in a negotiation with an agent.
Yeah, some good points there. Now, many investors are entering the market after strong growth has already happened when competition and prices are higher. The strategy then of identifying suburbs earlier, that is all about finding opportunity before the mainstream market catches on. But with so much information available today, is getting in early becoming the biggest advantage for property investors? What do you think?
Yeah, it's an interesting question, actually, and I think in different ways. There's different strategies depending on what your overarching goals are. Previously, we saw a lot of rent vesting and a lot of younger investors that were going aggressively after capital growth. So they were buying assets that were into a hotspot market, which guaranteed them short-term wins. They would potentially hold those assets for 3 to 5 years and sell. But with the government changes post-budget, higher capital gains tax, no negative gearing now on those properties, that has become way less attractive. I think if you can get into these markets at an earlier stage, you'll alleviate those negative points that I mentioned in question one, but also you've got the capacity then to hold that asset longer or further through a full growth cycle. And for a lot of my clients that want vanilla long-term de-risked investing, that's very attractive to hold an asset long-term and really understand where it is in the growth cycle and when you're entering into that process. So we like to enter into those markets in the early first, say, 12 to 24 months. That cycle has just gone above negative growth in the previous year. If it had a negative turn or it was sitting with a long plateau, we then can identify why that market's going to move. We enter it at that stage, as I say, with less buyer competition, more choice, and typically very motivated sellers because they've come off that negative growth period or a long plateau. And that's where we've got the capacity to have better choice and to negotiate better outcomes and buy at a lower price.
We are talking to Scott this morning. When we come back, we'll look at balancing risk and opportunity in today's market and why investors need a clear property strategy. That is up next.
Decode the property market with insider knowledge and insights to better navigate your real estate journey.
Right, it is time to have a look at the Caloundra property market update because Caloundra, it has evolved from a traditional beachside holiday destination into one of the Sunshine Coast's most competitive lifestyle markets, driven, of course, by interstate migration, coastal living, and strong buyer demand. The area just continues, doesn't it, to attract families, downsizers, and investors. The median house price at the moment is hovering around the $1.2 million mark. That is up 21.2% annually. Wow. While the units, they sit at around 865,000, recording an 8.2 annual growth. Houses are achieving, if you're looking at the yields, around $730 per week. That is a yield of 3.1%, while units are around $680 per week with a 3.9% yield. It is a Real Estate Thursday. Scott is here talking all things property. Now let's have a look at the current property market, which is creating uncertainty for many buyers, Scott. The challenge is finding quality opportunities without chasing short-term trends. A strategic approach means understanding where demand is heading rather than where it has already been. So what should investors focus on in this changing market in 2026?
Yeah, wow, Craig, what a hand grenade has been thrown in the last 6 weeks or so for property buyers in Australia. So I think over my 30 years, this is the most confused I've seen consumers, and it is a really tricky road to balance if you're not being guided by an expert. So I think it's going to go one of four ways, Craig. First, I think you're going to see a lot of transactional or volume-based buyers agents load into units with high yields or regional cheap properties, and I'm talking houses there with higher yields. Both those options are going to lose you negative gearing, and they're going to give away the preferential capital gains tax on exit. Why I say a lot of transactional people will be in that space is I think they'll be chasing yield as the headline, and they'll be selling the quick growth of those houses regionally. The problem is who's going to buy those assets off you down the line when either it hasn't seen much growth, and I'm talking about those units, or the houses, you've sucked the growth out of that market, you've depressed the yield, and then you can only sell to owner occupiers, and that market has hit an affordability ceiling. The second one I was going to say is duplex pairs. They become a bit of a unicorn. Again, you lose the negative gearing and capital gains tax treatment at the end. It will be stacked against your cost base, of course, but we've done the modelling that it's way less attractive if you can't retain that negative gearing day to day from a cash flow handling perspective. Those properties are very difficult to find in growth locations, and typically you're going to have to spend a lot more money than where the 600 to 900,000 average Australian investor is spending. So there will be some transactions there. The third one was going to be self-managed super fund until this week, where the Labor Party has, as I say, thrown that one into a bit of confusion for investors. So we're still unpacking what that's going to look like, but it may see us lose the ability to buy residential investment properties in our self-managed super fund. So that was going to be a very safe, unchanged lane. Where I think the market's going to go, based on where the government's driving it, is to the new build options. And really, I think the sweet spot there, Craig, is buying ready-built properties. And by that, I mean no construction loan, no risk of developer insolvencies, no risk of developer cost or time blowout. You can buy a property that is completed. It meets the criteria of within 1 year of age. So if you do that and you can cap the future supply of competing properties that our investors are going to purchase, that becomes a very attractive asset. They also yield very high because tenants want to lease these homes that have got brand new kitchens, brand new bathrooms, and just much better built than the older stock traditionally that they're going to see in those established markets. So I think, Craig, that's where the market will head based on the government direction.
Property strategy then is so incredibly important, especially when building a successful portfolio. It requires, understanding personal circumstances, market timing, and long-term strategy. And with so many of these options in property now, how important do you think is having a clear plan before making your next purchase? I mean, it's a given, really, isn't it?
Yeah, it's absolutely crucial, and it's very overlooked, I think, by the general consumer that's buying an investment property. They're not thinking longer term in terms of how long they plan to hold this property, what it's actually being purchased to do. Like, are they buying it to recycle debt and pay down their principal place of residence sooner? Are they buying for overall wealth creation long term that they plan not to sell? Are they buying for passive income at retirement? What is driving that? Because what we like to do is establish what the overarching financial goal is, so they understand what properties they need to buy with what yield at what price and at what stage, so that they can complete that path with ease, without stress. What I see mostly is investors that get stuck at one property because they don't have a plan whatsoever, and typically they buy an underperforming asset which caps them at that one property, or they don't have the vision to understand how to utilize their equity or the growth in that first property or their principal place of residence to unlock a second or a third to build real wealth long term.
All right, lots of takeaway points there, Scott. Thank you so much for coming on to the Real Estate Breakfast this morning. Good luck as you navigate for the rest of 2026, and have a great Tuesday.
Thanks, Craig.
We connect you to the best real estate information across Australia. The Real Estate Podcast.